Hey, this is KK again, coming in and helping you out with some financial planning advice. Thank you for joining in. I really do appreciate it. So today we're going to be talking about retirement planning. This is probably the most complicated thing that you can do, but I'm going to show you an easy way out of it too as well. So how do we figure out what retirement planning is? One, we got to figure out our budget. And then second, we got to figure out how much we're going to need in the future. So we did the budget template last time. So that's on a normal everyday when you're using expenses between 35 years old and 65 years old. When you decide to retire, that same budget is not going to be the same when you're 65 years old. We're going to assume that it's going to drop down by about 70%. Because you know what, your kids will have moved out. They're not using your food anymore. They're not using your water anymore. They're not using your electricity anymore. You may decide to downsize too as well. That's a possibility. So we have to adjust that budget. The other thing is that, what about your income? You know, let's say you're earning $100,000 today. Well, you're not going to need $100,000 when you retire. You'll have a lot of income left over. So what we're going to assume is that we're going to bring that down by about 30%. So we'll use, instead of $100,000 for retirement, we're going to use $70,000 for retirement. Now, what I am going to show you is on the board, and we'll go there in just a little while. I'm going to show you how to calculate it all out. After that, I'm going to show you actually an easier way to do it, but I just wanted you to understand how the calculation process works. Remember when I told you on my last video that if you recall, you know, when I was young, I remember going to McDonald's, and when I went to McDonald's, a Big Mac used to be 49 cents. Well, today it's about $3.99, I assume. So that's a big difference. So if you save 49 cents all those years and you brought that 49 cents to today, there's no way you can buy a Big Mac. So it kind of works out the same with your income too as well. So let's go to the board and I'll write some things out and I'll show you how to do it, okay? So let's go. All right, so I'm here. So let's assume that we're 35 years old today and you want to retire when you're 65 years old. So you got about 30 years of savings to go. So with that 30 years, you have to decide, okay, well, what do we want in that 30 years time? Remember, you're earning about $100,000 over here. And we assume that maybe when you retire, it'll probably be better if you earn $70,000 a year. Now, how do we get to $70,000 a year at age 65? So you can't use that $70,000 value. It's just not going to work. What we have to do is we have to bring that to the future. So this is the way to bring it to the future. We're going to take that $70,000. We're going to add inflation in there. So inflation, we're going to mark at 2%. So what we're going to do is we're going to take 1.02, which 2% is your inflation, and then you got that 30 years on top. So we're going to take it to the power of 30. Now that's going to give you a future value. Okay, that future value is 126,795 approximately. Okay. So that's basically what you need in that 30-year mark. Now, if you're going to be earning this, how long do you think you're going to need it for? So another calculation comes into play. So if you're 65 years old, you're going to assume that you're going to live till about 90 years old. So what does that give you? That gives you 25 years of income. And then you go down to zero, obviously, right? But there are ways to mitigate that too. So that's going to be 25 years. We're going to take the 126,795 and we're going to multiply that by 25. Now you're going to end up with a big value over here. So it's $3,169,882. This is exactly what you'll need for retirement. Now, this seems like a lot, and I'll tell you something, is that if we're going to be starting at the age of 35, it's a little bit late, but better late than never. So you should be starting earlier than the age of 35. You should be starting at the year of 25. But in today's age, I see a lot of families, a lot of people getting married, or common law doesn't happen until they're 30 years old. They don't start having kids till they're 30 years old. So it's kind of hard to put into somebody that they need to save before. But if you can do it, trust me, you'll be so much ahead of everyone else. So I'm going to show you a better way to do this. I just wanted you to understand there's a lot of complications to this. And the one last thing is that, remember, even though you need this value has to be brought back to today's value. So on the internet, I'm going to be posting a website on the bottom. It's from Sun Life, and Sun Life has a calculator. And what we're going to do is we're going to punch in the amounts in the calculator. Now, there are a couple of things on this calculator I want you to adhere to, is that this amount that I've calculated will not match the amount on the internet. And I'll tell you why. It's because what they're going to assume is that they're assuming that you're taking CPP, which is your Canadian Pension Plan, and OAS, which is your Old Age Security, into account. And what they do is they subtract it from this amount, because this is the amount that you need subtracted from those ones. Okay, so let's go back to our computer system, and I'm going to show you online how to get to it. So here we are, we're at sunlife.ca. As you can see, the address is kind of long, so I put it down below so you can click to it. It's sunlife.ca/en/tools and resources/tools and calculators/retirement savings calculator. As you can see, that's kind of long. So we're right on the website right now. As you can see, it says, tell us about yourself. So what we're going to do is we're going to punch in the age of 35, because that's what we calculated out to. And we're going to assume that we're going to retire at the age of 65. So our current annual savings is $100,000. And how much do you want to retire with? Well, we're going to put that at $70,000, because that's 70% of what we calculated up there. So we go to the bottom of the screen. We're not going to enter any of these things because it says savings and contributions, tax-free account, non-registered. We're going to leave all those at 0. And then even your defined benefit plan, we're going to leave it at 0. So we're just going to hit calculate your results at the bottom. Now it's going to bring you to the next screen. The next screen is probably one of the most important screens. So what it's going to tell you is that you've met 0% of your retirement goals, which you did because we haven't saved anything yet. And it says your retirement savings goal is 2.935 million. Now, if you recall, on the board, we were at 3.169 million. And remember, this doesn't account old age security or Canada Pension Plan. So they've included this in there. Now, their assumption is also on a 2% inflation rate. So it's pretty close to what we got. So when we look further down, explore your savings, we look at how much you have to save to in order to get to that amount. Well, your monthly registered savings needs to be at about $3,000. Now, off of $100,000, do you think you could spend $3,000 a month in saving for your retirement? And that's the thing, is we got to take what we have today and we got to put that into the future, because if you don't take anything from today, you're not going to get anything into the future. So we're going to take $3,000 a month and put it into the future. And this is how we're going to come up with a value for retirement. So I hope you can use this website and you'll understand a little bit more about it too as well. You can play with it. But at least it'll give you an idea of where you should be and how much you should save as you go along. Now, there are more calculations that need to be done, but I've done it very simple. I haven't taken into account what amount that we need to increase per year, because let's say you're making 5% a year or you're making 10% a year, and that's what you're assuming. Those assumptions haven't been added in there. What we've assumed is that about a 5% a year that you're going to be getting, and this is how you're going to get to it. So if you have any questions at all about retirement planning, please message me below. And don't forget, please share the video, like the video. You can also share it with anybody on YouTube, share it with anybody on Facebook and on LinkedIn too as well. Subscribe to my channel. It says right below, subscribe to my channel too as well. Really appreciate it. And thank you for joining in again. And take care. This is KK signing out.